everyone, and welcome to Ester Industries Limited's Q4 and FY19 Analyst and Investor Conference Call. We have with us today Mr. Arvind Singhania, Chairman, and Mr. Pradeep Kumar Rusagi, Chief Financial Officer. We will begin this conference call with opening remarks from the management, following which we will have the floor open for interactive Q&A session. Before we begin, I would like to point out that certain statements made in today's discussion may be forward-looking in nature, and a note to that effect was stated in the Concall invite sent to you earlier. We trust you have had a chance to receive the documents on the financial performance and also would have gone through the same. I would now like to hand over the floor to Mr. Singhania for his opening remarks.
Thank you, Suraj. Thanks, Suraj, and thank you everyone for joining us on our earnings call. I have Pradeep Rusagi with me, our CFO, who will run you through our financial performance for the period under review. But before he does that, let me summarize the key operating highlights and thoughts for our individual businesses going forward. To start off, FY19 was a strong year for us, a year wherein we reported revenue and profitability growth of 16% and 43% respectively for the quarter ended March 2019, and revenue and profitability growth of 27% and 488% respectively for the year. While the performance during the current year was largely film business driven, we are confident that you will see greater contribution from the other two businesses, namely specialty polymer and engineering plastics, in the coming years. The confidence stems from our hard work and on-ground positive developments, which I will talk about during the course of the call. Beginning with film business, we delivered a value-driven revenue growth of 37% for the year. Performance of the business improved due to continued strong demand, improved product mix, and better cost management. As we have been mentioning in our previous call, the sector fundamentals for the business has improved for the better. With demand remaining strong and with limited supply in the offing, we expect realizations to remain steady. Domestic demand continues to grow at a healthy rate, and we expect the market to absorb with minimal disruption the incremental capacity of Jindal, which is to come on stream shortly. Further, we are also undertaking measures towards improving our product mix by increasing the share of value-added products to 30% by FY21 from present levels of about 20-21%. We expect the film business to continue its growth momentum. Moving on to specialty polymer business. While the performance during the year was soft, we did see things picking up in the later part of the year. While we admit that the performance has been below our expectations in the last few years, we certainly believe the business is on the cusp of delivering steady and consistent performance going forward. Volume of sales of stain-resistant master batch MB03 has been in the range of 300 to 400 metric tons per year during the last 3 financial years. However, during the last 2 to 3 months, we have seen certain traction and a strong surge in demand for MB03 from across the carpet industry in USA and China. The sales orders and volume forecasts that we have received now from customers in USA in the month of April and May 2019 gives us confidence that we would be able to achieve sales of about 1,500 to 1,700 metric tons of MBOC during FY19-20 and 1,800 to 2,200 metric tons during FY2021. Expected dispatch of MB03 based on firm orders in hand during the quarter ended June 2019 will be in the range of 350 to 400 metric tons. Another major development that has happened during the year was a tie-up we entered into with a global chemical leader. We signed a manufacture and supply agreement effective April 2019 to supply innovative polybutylene terephthalate PBT. This agreement is renewable by mutual consent after 2 years. While the quantity of supply in the first year would not be very significant, there is a great possibility of a substantial upside. Just to give you a brief background, innovative PBT finds applications across varied industries and products and applications, automotive to consumer and from consumer electronics to fibers. Further, we are also making progress on few of our other products like deep diable master batch MB07 and cationic diable master batch MB06. MB07 has already been approved and the commercial sales have begun, albeit with small volume. Approval for MB06 is in the final stages. Both these products have very good potential and we can expect volumes to start picking up during the course of FY 2020. We expect FY20 to be a much better year for specialty polymer business on the back of such encouraging and positive developments. We have always maintained that this is a R&D driven business wherein the gestation period is generally long and it takes time to deliver the returns. However, we believe that the initial learning curve is now complete and we should be able to accrue returns for our investments in this business going forward. Moving on to engineering plastics business. Revenue growth of about 14% driven primarily by higher polymer rates was significantly higher than volume growth of 1.2%. Lower demand and increased competition coupled with polymer rate crash in half two, impact of US-China trade war, led to higher cost inventory, resulting in margin and profitability compression. We are undertaking measures towards strengthening the business by improving its product portfolio, increasing the share of value-added products. We are also working towards containing the costs and expenses for the business, which would help us improve the margins. In addition to the above, our cost rationalization exercise is also progressing well. As most of you must be aware, we had embarked on cost-cutting initiatives wherein we had identified certain areas and measures by which we will be able to significantly cut down on the expenses. I am happy to report that we have been able to achieve annualized savings worth 10 crores during the year on the back of such initiatives. This initiative will further continue during the course of the year and we expect to bring in further cost reduction by March 2020. To conclude, I would just like to state that we expect the business momentum to continue. We believe the current year to be more productive and profitable as the same will see positive contribution from the other two businesses as well, more so from the specialty polymer business. We expect film business to continue to perform well and we are confident that we can significantly create value for our shareholders in the coming years on the back of improving performances. With that, I hand over the floor to Pradeep, who will run you through the financial performance.
Good afternoon, everyone, and thank you for taking the time out for our call. I trust that all of you have received the investor document circulated by us earlier. Let me quickly summarize the key financial highlights for the quarter, following which we can begin the Q&A session. Starting with the top line, our revenues from operations for the quarter ended March 19 stood at rupees 255 crore as against rupees 220 crores reported during Q4 FY18, higher by 16%. While on annual basis, the same stood at 1,028 crores as against rupees 824 crores reported during FY18, higher by 25%. The growth was primarily driven by film business, which grew 37% for the year. Performance of the other two businesses remained relatively muted. However, we expect the same, especially specialty polymer business, to pick up and contribute positively to the overall growth in the coming years. EBITDA for the quarter stood at rupees 29.47 crores as against 22.67 crores generated during Q4 FY18, higher by 30%. While on a yearly basis, the same stood at rupees 108.78 crores as against rupees 65.63 crores generated during last year, higher by 66%. Higher revenue growth coupled with prudent cost management resulted in delivering higher profitability and margin expansions. Finance cost for the quarter stood at rupees 7.79 crores, while on a yearly basis the same amounted to rupees 34.21 crores. As on March 19, our outstanding interest-bearing term debt stood at rupees 75.97 crores, while interest-bearing working capital liabilities stood at rupees 166 crores. Interest-bearing debt as multiple of EBITDA on an annualized basis stands at 2.15 as at 31st March 19. Term debt tangible net worth ratio stands at 0.38 and total outside liabilities tangible net worth ratio stands at 1.12 as at 31st March 19. We are confident of maintaining debt T&W ratio at prudent level going forward. Term debt repayment obligation since last many years has been in the range of rupees 40 to 44 crores. As mentioned in the previous calls, starting from FY 2020, the term debt repayment obligation will reduce to about 20 crores per annum. Prudent level of debt and reduced repayment obligation has helped the company achieve comfortable cash flow position. Comfortable cash flow situation would enable the company to spare funds for expansion in future. Liquidity position of the company as indicated by net working capital and current ratio has improved significantly with net working capital 4.62 crores and current ratio at 1.26 as at 31st March 19 as compared to net working capital of rupees 3.92 crores and current ratio of 1.01 as at 31st March 2018. Depreciation for the quarter and full year stood at rupees 8 crores and rupees 32 crores respectively. Profit after tax for the quarter stood at rupees 8.05 crores as against profit of 5.61 crores reported during Q4 FY18. While on a yearly basis, PAT stood at rupees 31 crores as against a profit of 5.29 crores reported during FY18. To conclude, we believe that due to traction and positive development seen in the last 2 to 3 months, specialty polymer business would contribute significantly to the profitability of the company going forward. While we believe that film business will continue to deliver consistent performance, especially polymer business will drive the overall profitability. We are hopeful that our efforts towards strengthening the Indian plastic business should also complement and contribute to the overall growth of the company. That concludes my opening remarks. We would be happy to answer your questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aman Santalia from AK Securities. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, my question is, how is the current international and domestic scenario for the BOPET?
The current domestic and international scenario for BOPET is quite strong, as can be seen from the results. The margins are strong. The demand is very strong. And we expect the domestic demand to continue to grow at about 11 to 13% per annum, which is very strong.
And, sir, what about the international scenario? Because I think we export some quantity of BOPET in the international market also.
Yeah, we export substantial volumes in the international market, and the international markets are also quite strong.
So the margin in Indian market is higher or in the international market is higher, sir?
More or less the same. I mean, give or take a few rupees.
Okay. And sir, what is the spread right now in the BOPET? What it was in the previous quarter?
If I take a 12 micron commodity product, approximately gross value additions are in the 50 rupee range.
How much, sir? 50 rupees.
50 rupees. Gross value addition. That means the selling price minus raw material cost. 55.
50. And what it was? 55.
55.
And what it was in the previous quarter, sir?
Sorry, what? In the previous quarter?
In the December quarter, sir.
December quarter, it was about 51. December quarter was less. December quarter, I'll just hold on a minute. December quarter, it was about 42 rupees.
So there is an improvement of 13 rupees.
It improved to 51 and current is about 53 to 55.
Okay. So 51 to 53 to 55. And sir, any new capacities coming up in India and in the international market?
India, one line of Jindal is expected to start around June, July.
So whether it will impact the demand supply balance, sir?
No, because with minimal disruption.
Okay, sir. And any fresh capacity, major capacity coming in the international market apart from India?
I think there are two lines, one of Polyplex coming up in Indonesia and one of SRF coming up in Bulgaria.
No, sir, I think Hungary.
In Hungary. Yeah.
Sir, why a lot of companies are setting up plant in Hungary, and whether the company is also planning to set up plant outside India?
We are not at the moment planning to set up any plant outside India.
And sir, recently I've seen an article in the newspaper that there may be a slowdown in the FMCG sector. So whether it will impact our demand?
We don't expect the demand to be impacted for us because the demand for low value is not disrupted where our product is used. The demand for the high value packs is affected, but not for low value bags. So, for example, people are not buying less of shampoo bottles and increasing their purchase of shampoo sachets. Our product goes into sachets. Our product doesn't go into bottle. So, in fact, this slowdown in FMCG for large value bags may, in fact, help improve the sales for our product.
Okay, got it, sir. And, sir, what is the current turnover of polymer?
Special polymer, we ended the year with 39 crores.
About 40 crores.
And how much we are expecting in the year 2019-20?
In 2019-20, we expect our turnover to be about anything between 80 to 100 crores.
And 80 to 100 crores. And, sir, one last question is, what is the cost of setting up a 30,000 tons plant for BOPET?
If I were to go to a greenfield location, it would be about 300 to 350 crores.
300 to 350 crores. Thank you, sir. Thanks a lot.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Good afternoon, sir. And sir, congratulations for a very neat and tidy set of numbers, and congratulations for a well-explained presentation also. Sir, the first point is, sir, we see our revenue declining Q on Q sequentially, and I think so it is the raw material fall in the raw material prices that has added to the margin, or it boosted the margin. So how will you explain how has the raw material basket behaved for the last quarter, and how are things as on today?
Pradeep will give you the raw material movement for the last 2 quarters.
The current raw material cost is about, if you look at the March quarter, it was about 73 to 75 rupees, and now it has improved. It has reduced to about 71 rupees currently.
What was it in December?
Okay. December quarter, it was, just hold on for a minute. December quarter, it was close to 78 rupees, 76, 78 rupees.
Okay, sir. So more granular details, how have the MEG and the other component prices been for the March quarter vis-a-vis December quarter?
There's been no major volatility.
Yes, sir.
There has been no major volatility in the raw materials in the last quarter.
MEG prices remain, sir, in a band only.
The MEG is currently about, current prices are about 45 rupees a kg, and PTA is about 65 rupees a kg. The current, as we see now.
As of the month of May?
As of now, yeah.
Okay, and what were the average prices for the March quarter for MEG and PTA?
March quarter, it was, just hold on for a minute.
Yes, sir.
It was about 70.
MEG, it was about 74 rupees for both put together. MEG was about 49 to 50, and PTA was about 68, 69.
Okay, so it's a 10 to 6% decline, 5 to 6% decline was there in the raw material, and it is in that band only for this quarter also, as of now.
Yes.
So since January, the prices have not been very volatile. October to December was very volatile, and so was the case with July to September.
Okay, now the prices have plateaued out, sir.
Yeah.
Sir, we also find in the P&L account that the employee benefit cost has gone up, sir, from 11 to 14.5 crore. Is this any one-off that has been factored for this quarter? What should be the annual rate for the next year?
The employee benefits has maybe has gone up because of the commission paid to the directors.
So there is a provision for increment of 1 crore that we have made in this quarter for the staff, and then there is a commission payment to the directors.
Okay, what is the percentage paid for the directors, sir, the commission?
The directors, the 10% of the PBT.
10%
overall is about 11%, 11 to 12% of the profit.
PBT at PBT level or PAT level?
At PBT, under section 198, it is at PBT level.
At PBT level, it is 12%.
12% of the profit.
11%. 11%.
Okay.
11 to 12.
11%, sir. And sir, as for the shareholders, have you formulated any dividend distribution policy, any laid out path that we will be distributing this X percentage of the profit after tax as dividend?
No, we don't have a written down dividend distribution policy. However, we have recommended a 10% dividend payment for FY19.
50 paisa per share.
50 paisa per share has been announced, sir.
The face value is 5 rupees per share. 10% is 50 paisa per share.
Yes, sir. And we have an EPS of 3 rupees 73 paisa. So in
3.75.
3.75. In that case, it is likely in the vicinity of 15% only, 13 to 14%, if I'm not wrong.
Yes. So the payout is about 15%. At PAT level, it is 15% of the dividend.
Okay, sir. So we should look at this payout ratio maintaining, or are we looking up for, since you are guiding for better cash flow for next year also, this is the minimum we should expect in terms of the dividend distribution, just to have an understanding of the level?
I cannot comment on that right now. This is something that the board has to take a view on creating
okay, sir. But generally companies are coming up with a late policy. So that was my, if you could look at it in near future, bring it to the board level.
We take your suggestion and we will put it up to the board. Okay,
right, sir. Sir, for this quarter, sir, there was a sequential decline in revenue also, sir, from the December quarter to the March quarter. What was the major reason for the same, sir?
Because the raw material PT MEG rates were lower in March quarter as compared to December quarter.
Okay, right,
sir. Margins improved, but overall selling price was lower than December quarter.
Okay, sir. Mr. Rastogi, could you explain what the cash flow has been for this year and how has been the utilization of cash for the entire year?
So this year we made a EBITDA of 114 crores, out of which close to 10 crore has been paid as MAT, minimum alternate tax, MAT, and 44 crore has gone for the repayment of tax. We have spent 22 crores on the capex during the year.
44, 22, 10.
Yes, that is to improve the net working capital.
Balance will be there for the improving the working capital.
The gap between current assets and current liabilities. So 10 plus 44 plus 22. That's very major. It's about
76 crore. 76 is, and the remaining.
And if you look at PBT plus depreciation is about 80 crores.
Right, sir.
So 80 crores means 76 crore is there, and balance 4 crore is going to the in the working capital.
Thank you. I would request Mr. Kapoor to come back in queue for follow-up question. We'll take the next question, which is from the line of Giriraj Daga from KM Vaisaria Family Trust. Please go ahead.
Yeah, hello, Tim. My first question related to the MB03. So, what this guidance of 1,500 to 1,700? Can you just tell me what are the number of customers we are assuming in that?
3 customers.
3 customers. About few months back, we gave the guidance of the Shaw Industries. So that should be the largest customer there?
I cannot take the name of any customer, but yes, they are also part of the customer list.
Okay. And second, when we talk about, let's say, 180 to 100 crore of revenue, is it entirely coming from MB03, or we have assumed some other products also to be part of this?
No, majority will come from MB03. And then we have also signed a 2-year long-term agreement with a major, one of the largest petrochemical companies in the world for supplying the innovative polybutylene PBT, polybutylene terephthalate product.
Okay.
So this is a very interesting agreement that we have signed, and the contract, the volumes in the first year are not very substantial, maybe 400-500 tons. But the potential in this business is to go up to maybe 4,000-5,000 tons over a period of the next 2-3 years.
Okay. And what is the revenue we assumed from this for this year?
So 400 tons if we do this year, as per the contract, 18 to 20 crores. It will be about how much?
18 to 20 crores.
18 to 20 crores. That's how we. So we expect to do at least about 1,700. I've given a guidance of about 15 to 17, but most likely we will be closer to 1,700 tons in MB03 this year.
Okay.
At 1,700 into 400,
68 crores.
Is about 70 crores will come from MB03.
Okay.
And 400
$1.6 per year.
And about 15 crores will come from So about 15 to 20 crores will come from the PBT contract, and then there will be some other smaller products.
Okay. My next question is the sustainability part. Like obviously, last time we guided, we couldn't deliver that. So what is that like this time the contract? You also gave the first quarter is good, so obviously that will give confidence to the investor. But what is the sustainability part? Do you expect this to be now a recurring exercise, or it's still a trial and error? The customer will take it and he might review again. He might not give the second time order. What is your take on that?
I think this time around we expect it to be very sustained. In fact, while we talk, this quarter itself will be dispatching around 350 to 400 metric tons of MBO3 in June quarter. And we have a clear line of sight from all the customers of the volumes that they intend to pick up.
Okay. And
we are very confident that we'll be able to sustain this volume and rather grow them as time goes on.
Okay. And my last question is on the BOPET side of it. So when the general capacity will be coming in the industry, the domestic, do you expect any spread reduction, or do you think that even if higher export we will make, the industry has to make, the spread will sustain?
We expect that with increased exports, the spread should be maintained. There may be some minor disruption, that initial jerk when a new capacity comes in, maybe for a few weeks or so. But we expect this new Jindal capacity to be absorbed without major disruption.
Okay, sure. And thanks a lot.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Path Aditya from B&K Securities. Please go ahead.
Hello. Thank you for taking my question, sir. So my first question would be towards the engineering plastic side. I wanted to know if you manufacture ABS in your company?
No, we don't manufacture ABS. We buy ABS and compound it.
Okay, you're basically compounding ABS. And second thing was towards the BOPET side. What would be your market share in BOPET in the domestic market?
About 9 to 10%.
9 to 10%. Okay. And another thing was again on the ABS side. I actually want to know if so recently there has been since there was in the US-China trade war, China has actually planned to impose tariffs on the ABS part as well and the engineering plastics. So I want to understand the impact of that if it would be possible.
We have very very minuscule volume in ABS business.
Okay. We don't source it from all, and we don't source it from US.
Okay. So, sir.
In any case, the tariff war is between China and America. India is not really involved in that.
Okay, not much impact. Okay, thank you, sir.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Sunny Agarwal from PNB Investment Services. Please go ahead.
Thanks for the opportunity. Sir, would like to know what is the capex plan for FY 2021? Thanks.
FY20 the FY20 capex plan is about 35 to 40 crores.
Okay. And that will go in which segment?
Okay, so we are putting up a downstream coater, offline coater, to make value-added polyester film.
Did you ask capex plan for 2021 or 1920?
For FY20 as well as 21. So even if you give me for the current financial year, it's okay. I mean FY20 will be okay. Yeah.
What I'm giving you is for the current financial year, that means 1920, FY20.
Yeah.
About 20 crores will be spent on an offline coater to produce higher value-added polyester films. So this is what is going to help us take the volume of value-added products in polyester film from 20 to closer to 30%. Okay. 20 crores is being spent there. About 13 to 15 crores is being spent on an extrusion system for recycled material, which is primarily to service this big contract that we have got with the International Petrochemical Company. And products from this will also be used to make other specialty polymers from recycled material.
Okay.
And balance for maintenance capex is another 10 to 15 crore would be for various other capexes.
Okay, understood. Thank you. All the best.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is a follow-up from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Sir, as seen in slide page number 6, we find polyester films contribution to be was 803 crore for this year, specialty polymer 30, as engineering plastic was 195. So with the type of order booking we have for the specialty polymers, we are looking at a turnover of 80 crore you specified for this year in the specialty polymer segment?
80 to 100 crores.
80 to 100 crore. And sir, with this, the fixed and the variable cost part should also play, and the EBIT level, we should be better off than what we posted for this year as a whole.
At the EBIT level, the specialty polymer will improve.
We were negative last year, 18-19. We should be in the range of 30 to 35 crores EBIT in specialty polymer on a turnover of 80 to 90 crores, which is about 40%. 40%
EBIT margin.
So didn't get you, sir. Come again.
So basically, specialty polymers will contribute. We expect specialty polymers turnover to go up from 40 crores to about 100 crores. Turnover to go up from 40 crores to 100 crores approximately, and EBIT, which was negative, will be at about 40 crores.
Okay, sir. Because what I'm seeing,
specialty polymer business will give up EBIT margin of about 40%.
40%. So what I am seeing at the EBIT level, page number 6, you have mentioned specialty polymer turnover for FY19 at 30 crore and the EBIT at positive at 1 crore, which is lower.
There has to be a certain threshold beyond which the increase in EBIT margin is more than after crossing a certain threshold volume.
Right, sir. So we will be looking for.
Basically, the specialty polymer business should contribute 40 crore additional over FY19.
40 crore.
Yeah.
At the EBIT level.
At the EBIT level.
At which was 1 crore as seen from the slide for FY19.
Absolutely correct.
Okay.
So increasing contribution would be increase in the EBIT.
Right, sir. And sir, how is the... Yes, sir.
Because the fixed costs are not very high in the specialty polymer business.
Yes, sir. Absolutely right, sir. And how should we look for the polyester film and the engineering plastic contribution for the coming year? What should be the ballpark figure we should?
Well, film business is concerned, you should see a top line improvement marginally because we've been able to debottleneck our lines. And we expect production increase by about 8 to 10%. Am I right? By about 8 to 10% in FY20 over FY19. So there will be a 10% increase in volume. And if the margins, if I take the blended margin for FY19 and compare it to the expected blended margin of FY20, the FY20 margin will be better than the FY19 margins.
Right. So there is a clear-cut understanding that the EBIT in the polyester will also grow for this year with the improvement in margin. That will also add incrementally with the improved turnover.
Yes.
Right, sir. Sir, engineering plastic somehow has its vagaries with the raw material fluctuations. So now, as the prices of raw material remaining plateauing out, how are you seeing this segment contributing going forward?
See, in FY19, engineering plastics was hit the most because of this America-China trade war. There was a crash in raw material prices in September, October, and this particular business of ours was hit maximum. Now, like you rightly said, the prices have stabilized, and if no other unforeseen event takes place, we expect the engineering plastics to do a much better performance than FY19. If this problem had not occurred in Q3, Q4 of last year, the engineering plastic itself would have performed better.
Sir, so for the revenue front, what kind of top line are we looking for engineering plastic going forward at a ballpark figure? We did 195.
It should be about 200 crores plus minus 5 crores. It would be in that range.
We did 200 for the last year only, so we will be in that ballpark only.
The last year, the first 6 months, the prices were very good. Then it dropped, and then it started to stabilize. So I'm taking an average, and we should be in 200 plus minus 5 crores.
But there will be a more improvement in the margins.
Margins will improve better, sir.
Yes.
What kind of margins I should be penciling in, sir? Because this was an abnormal year, considering the fluctuation in raw material. Had this been a normal year for us, what would have been the contribution from the engineering plastic segment at the EBIT level?
Theoretical, actually.
Very theoretical, this thing, but I would imagine that going forward, the margin number for engineering plastics will be much better than FY19. That's what I can tell you right now.
Okay, no ballpark figure, sir.
No ballpark figure.
Okay, sir. Do we have SAPs in our system implemented?
SAP, yes.
Yes, we are SAP all across.
SAP for 15 years.
Okay. So, sir, just wanted to have an understanding, sir. Is it feasible for the board to meet earlier to come up with numbers and not reaching that 45 days time period to come up with numbers? Say when we are coming up, when the quarter ends at March, we try to come up with numbers somewhere in the middle of April, say 2022, and not taking elongated period for the same. If we could think over it, how can the system be upgraded so that investors are best positioned to receive the numbers earlier than what it has been done now?
We are in the process of upgrading our system, and hopefully, in fact, we are doing a complete business process automation program is being commenced by the company, and hopefully it will be completed by before FY20 ends. So you should start seeing results sooner than 45 days going forward. Not immediately, not maybe in the next couple of quarters, but certainly starting from the first quarter of FY21.
Thank you. I would request Mr. Kapoor to come back and queue for follow-up question. We'll take the next question, which is from the line of Aman Santalia from AK Securities. Please go ahead.
So right now, as you have said, the profit is around 55 rupees. So going forward for the next 1 or 2 years, how you foresee the margin in the profit?
It's 2 years is very long to predict, but certainly for the current year, we expect the margins to be sustained with minimal disruption because of the startup of Jindal.
Okay. And one more question, sir. Why most of the company are setting up plant outside India? What is the reason for that, sir?
That is something that you have to ask them. But so we are not planning to set up a plant outside India.
Okay. Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is a follow-up from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
So my last point was on the finance cost part. I think so, sir. You spoke about this 10 crore saving for this year. That has been factoring into the. How is that factoring in? And what kind of finance cost are we looking forward for the coming year with improved revenue?
The savings of 10 crores that we achieved during last year has not been fully factored into the FY19 because it was achieved during the year. The full effect of this will come in the balance sheet of FY20.
Okay.
And going forward, the interest cost, Pradeep will explain.
Our average interest cost has been about 11%, and depending on the repayment schedule that we have and the level of current assets, etc., we should be seeing a reduction in the overall interest cost by about 2 crores. As against 34 crores, we should be at about 32 crores next year.
With the improved revenue?
Revenue would also call for additional working capital requirements.
No, sir. After factoring in the enhanced business.
After factoring in.
After factoring in the enhanced business, sir. Correct, sir. Thank you, sir, for answering the same, sir. Thank you.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you, everyone, for joining us for the Q4 FY19 earnings call of our company. We look forward to being with you again after the end of Q1 of FY20. Thank you.
Thank you.
Thank you.